if I've got a low rate and I'm sitting there with a lot of equity, I'm probably not interested in moving. And so that just makes the housing supply issue even worse.
Welcome to Actualizing Success. In this podcast series, our in-house advisors discuss today's finance and technology topics with an emphasis on solutions that embrace tomorrow.
Hi, my name is Kerry Wekelo, and I'm the Chief Operating Officer of Actualize Consulting. And today we have our partner, Matt Seu, with us to talk about the mortgage industry. Hey, Matt, how are you?
I'm doing well today, Kerry. I got to remember that COVID's over. I've been nothing short of busy on the road, attending a lot of conferences and so forth, and really getting a lot of feedback from the market. It's been really refreshing, actually. So I thought it would be good for maybe to give you a little bit of an overview of what I've seen over the last couple of months.
Great. That sounds like a perfect place to start.
All right. Very good. So, I think after going to the mortgage servicing conference and hearing about the ICE event and to a VA loan guarantee event, and among a bunch of other things, the one thing that is really interesting is that I'm getting consistent information across the board, which is terrific. And where I see that there's been a lot of energy in the servicing side of the house, the origination space has really been tough, and I don't know that's that much of a surprise, but it does kind of illustrate where we are as a mortgage business, and just some things that are a little bit of statistics and so forth that might help explain a little bit about it. Rates right now are very high. And we'll get into that a little bit more in a minute, but what's really been the pattern is that you've seen so little supply on the market in terms of housing, and that's continuing. And yet at the same time, because rates have gone up, folks aren't refinancing and they're building equity. So it's a situation where most of the consumers that have a house with a mortgage are building a lot of wealth in the short run, but it's almost like they're being locked into a situation. So, what are the impacts of that? Well, if I've got a low rate and I'm sitting there with a lot of equity, I'm probably not interested in moving, and so that just makes the housing supply issue even worse. And new housing starts aren't out there. I mean, we live in an area in Northern Virginia where we do still see quite a bit of growth, but in other areas, you're seeing very little new housing starts. And in fact, you're seeing a lot of areas where we're seeing a decline in population, and things are just going to be tough. And so, I'd say that as we've been to a lot of these events lately, we've consistently been hearing the same things. And again, back on the servicing side, because we have seen so few people selling their homes and moving, that makes that business an awful lot simpler in terms of worrying about churn and people refinancing and stuff. And so the servicing business and the MSRs in relation to that have really held up. And I don't know that we're going to see as much default as maybe some people had predicted before. And again, that gets back a little bit to how much equity people have in their homes. So, pretty decent amount of information that I've been getting.
Okay. That does sound like there's a lot going on. What are you seeing in terms of the trends in the market right now?
Yeah, well, I mean, I think that we've seen just recently another 25 basis points movement by the Fed. They've pretty much hinted that that's probably a pause in rate increases. But I do think that they've also indicated, and specifically because unemployment is so low, that, in order to curb inflation, there may need to be at least one more movement in rate. But I think most of the market is kind of baked in the thought that there's a pause. And so what does that mean? It means that you're going to still see an enormous challenge in the affordable space. So as I had mentioned, already, that servicing is benefiting from this. The ability to originate is really tough. I mean, you just look at where rates were a year ago. We were just starting to see increases, and now we're well into the sixes, and some places have forecasted as high as 8% this year for a rate. Well, coupled with that is the increase in real estate prices. And when you take that, it's kind of a double whammy. So with the increased amount of P&I that you have to pay, given the rate increase, plus the rising prices of homes, it just makes it really, really difficult for affordable and how people are going to be able to get their first homes. And so my expectation is that we'll continue to see this. There's not anything really that's showing home price depreciation. And I think the forecast is for a small increase for the rest of the year. There are some places where we've seen migration out, specifically the Pacific Northwest, LA, San Francisco Bay Area, parts of Arizona. And so in those areas, we are seeing a lot of movement and perhaps some home price declines. But guess what? Those are some of the areas that are the most expensive. And so talking about affordable in California and the Pacific Northwest and Arizona is not always a simple conversation. But, I think that what we're in for really is a fairly steady state for quite a long time. As much as we should see some home price appreciation and perhaps a little bit more housing supply come up, I don't think rates are going to move downwards within the next year, perhaps a little bit. But I think that most of the folks that follow rates are thinking that we may even have that one more increase before they start to move downwards. So, again, I think same type of thing for a long time. And again, I don't know that that's great for folks that are trying to get into their first home. So
that's unlucky timing for them.
And in fact, the timing is exactly that. It is unfortunate. And my son's actually getting a first home with his wife. They go to closing tomorrow, actually. But they've been working for a while, so they're a little bit farther along in terms of the first-time home buyer age, and they've been able to accumulate some wealth. They were in the Bay Area and making a lot of money there, and moved to another part of the country that's a lot less expensive. But I think those are really more of the outliers, and so I think that it's going to be tricky.
Well, on to another topic. How is the attention on bank stability impacting the mortgage market?
Well, so this is a complicated question. So first and foremost, people are definitely paying attention to it. Let's not think the other way on that. But I also, when you look at how the mortgage industry has changed over the last 15 years, some of the biggest banks have fled the mortgage space in large part, or at least the mortgage servicing business. So entities like Chase and Citi, they're nowhere near as much in the business as they have been. And so what happened over that time period is you saw companies like Mr. Cooper, Lakeview, a lot of companies that are very well known and large are actually non-bank entities. They're lenders, but not banks per se. And so they aren't necessarily under pressure for the same reasons that the banks are, but there are some other implications on it. And so if you think about a non-bank, they don't have the capital to hold loans. They certainly don't have the deep pockets that a bank has in order to come to the closing table and fund the purchase. And so they rely heavily on warehouse banks. Well, what if some of the warehouse banks start getting pinched? They'll certainly raise their lending fees in order to accommodate the risk, which does put pressure on the non-banks from a cost perspective, by the way, then making it even more difficult, pinching the affordable even more so. But, if there is a shortage of warehouse banks or they start pulling out, that's really going to be tricky, because then you're going to be in a problem where there's not enough liquidity in order to allow these loans to go through the process. There was a period of time during the default crisis when warehouse lenders pulled back, not because of the same issues, more so because of the risk of loans falling out and entities going out of business in the middle of the transaction. But it could be, very similar in terms of the overall impact, the creation of less warehouse lenders. And, so I would say, in fairness, it could be a little bit of a domino effect, or it could be more than that. So right now, I would say that the bank stability problems are going to have limited impact on the mortgage space in terms of the non-banks, but it could turn up. Now, of course, any of these banks that are under pressure that are lenders would certainly create problems there. But my mind is a little bit more on the positive side on that part of the conversation.
Well, that's always a good way to look at the positive. There's always a positive in anything that's happening. If anything, it's also, making sure that the risk is being looked at as well. Now, if you could predict what the industry looks like next year at this time, what would you say?
Yeah, sure. I kind of alluded to this a little bit earlier when I was talking about rates and affordability. I think that you're going to see some significant consolidation still. So where today you've seen some fairly decent sized companies be acquired, I do think there's going to be a lot of pressure on the lenders in terms of profitability, and just not having enough mortgages in the market to make a lot of money. And of course, we all know that most of them did nothing other than pick up fee revenue and become even more fat and happy. And so, I think there'll be consolidation. I think you'll see companies get acquired. I do think also that you're going to see something similar, if not more dramatic, in terms of the mortgage tech space, especially some of the more recent emerging companies, fintech or otherwise. These companies are generally compensated on a per loan basis. And so with the lack of mortgage originations, it really, really gets difficult for these folks to survive. I think that, we've seen companies like Roostify get acquired by CoreLogic. I think there's others that are hanging on by a thread. And so I would suggest that in a year, we're going to start to see more and more shakeout in that. And then the other piece that everybody knows about is, what about the ICE and Black Knight transaction? They're so big and they dominate so much of the market that, clearly there's concern about antitrust, which is being worked through. But if, for example, they do consolidate, I think it's going to put much more pressure on the smaller new entrants. I think if not, then maybe there's some room for growth and so forth. So I think that's the highest level. I predict that there'll probably be a couple of new companies that come in to disrupt the servicing space and come in with a little bit of a better mousetrap on a servicing tech perspective. But, my crystal ball only is so clear. And of course, I really can't predict the future. I would say, if you asked me longer than a year, I think we're going to be in a very long period of static / very little interesting things happening in terms of volume. So as much as it's awesome for people that have a very low interest rate and don't want to refinance, I just don't see things changing in a big way to create an enormous rate reduction and refi wave. So I think we're going to kind of be in this market. I would suggest rates will move up and down here and there depending on the economy. But again, that's more of what we were used to from the 90s into the 2000s prior to the default crisis. And so, is it the new normal? I don't know. It seems to me like that's just the way it was, and that a lot of what we had after the default crisis was really an unusual time period. And so, the only last thing that I would say is we are, next year at this time, we're well into the primaries. And, so I think we'll start to get a feel for whether the Republicans or the Democrats may take some of more power. And clearly, the Republican side is going to be pushing for less government involvement in the mortgage business. And I think the left agenda, which we've seen through Obama and Biden, is very much that the government not only is involved in the mortgage business, but continues to have much more control of the regulations through the GSEs, through the government agencies and the regulators. So I really don't have any idea. I think that, the chance of us getting a candidate that really is going to work across the aisle is very remote. But, the one thing that you can always say, no matter how clear your crystal ball is that the mortgage finance and housing sector is an enormous part of our economy, and it's very important for the viability of our GDP, and it will be important regardless. So my hope is that nothing comes up that will create instability and chaos. Let's hope, right? So
yeah, let's hope. Yeah. That would be good. No, and I know we always say, everything kind of cycles through, but it's interesting to hear, maybe we don't go back to, as low as of interest rates, and it goes back to, what we remember a bit more back in the day. So very interesting. Yeah. And for Matt, sure. It's always a pleasure to have you on. Definitely appreciate it.
Yeah, just thank you so much for having me. And I know that I'm one of your best customers for these podcasts, but honestly, if there's ever any questions, you know where we can be found.
Thanks for joining us for today's episode of Actualizing Success. Make sure to visit us online at www.actualizeconsulting.com, where you can explore our service offerings. Don't forget to subscribe to the show on iTunes, Spotify, or your preferred platform. If you've enjoyed what we talked about today, please consider leaving a review and following us on LinkedIn. If you have any questions or would like to share your opinions with us, please send us a note at podcast@actualizeconsulting.com. We look forward to hearing from you.